You're listening to the greatest multifamily investment advice show. My name is Adam Ras, and now I'm talking everything multifamily for an in-depth conversation, and I will be diving deep into raising capital, deals, and underwriting process. Welcome back to the greatest multifamily advice show. Today we have Travis Watts, an exceptional guest and the director of investor relation in Ashcroft Capital, focus on coaching and multifamily business. How are you, Travis?
Hey, Adam, I'm doing great. I appreciate the invite.
Thank you so much for being with us today, and I appreciate you taking the time.
You bet. Thank you.
So your background is super impressive, starting as a single family investor in Colorado and then moving to large multifamily and then coaching and focusing now on the passive investing. But I would like to start with beginnings. What was the beginnings for you as an investor?
Sure. Yeah. I think that, well, there's a couple of ways I could tell this story, but my parents raised me very frugally. And so from childhood, I learned a lot about just saving money, right? Put your money in the bank, save for a rainy day, use the coupons, buy the off brand, don't buy things you don't need, don't go into debt, all that good stuff. But, at a certain point, probably around 16, 17, 18, somewhere in that range, I got to thinking, even if I had a high income, let's say I had a nice solid job, I made $10,000 per month or something, I still got to pay for my living. I still got to pay taxes. I still got to pay, insurance and bills and healthcare and all the rest. And even if I'm very frugal and I'm very disciplined and I'm an avid saver, I'm still, my max potential with that outcome is saving maybe $3,000 or $4,000 per month. And I'm going to be capped right there for the rest of my life. And I thought, well, A, that doesn't seem very enjoyable. And two, I don't see that really building substantial wealth over time. So that started my journey into exploring the investing side of the coin, which I was never taught. And so that was done through mentors, that was done through books, podcasts like this one. And I started to realize there really is no cap on your earning potential when you become an investor. Is it possible you make 10,000 a month with investments? Absolutely. What about 20? What about 50? What about 100? There's people making, $1 million a day in their businesses. So there really isn't a cap. And I thought that's a lot more inspiring to me. So I want to start that journey. So that was kind of the mindset in the humble beginnings. And the way I actually got started into real estate, to your point earlier in the intro, was single family homes. So, call it what you will, dumb luck or just coincidental timing, but I was ready to start investing in 2009. The markets were all still falling. That included real estate. Yeah. But I decided I wanted to try real estate because I was kind of captivated by passive income and cash flow and this concept that maybe one day I don't have to work for money. My money works for me. And so I got a roommate. I bought a little 2-bed, 1-bath townhome out in Fort Collins, Colorado, next to Colorado State University, a little college town, kind of. And I thought, I just came out of college. So I thought, I know there's a lot of demand for people who want to live off campus, independently like I did. And so I rented that spare bedroom out for $600 per month. And my mortgage was $600 per month or $640 or something like that. So it was essentially living for free right outside of college. And so that got the wheels turning. And I ended up doing fix and flips and vacation rentals and buy and hold single family, and everything was active. And at first that was fun. And over about 6.5 years, it grew to be a little bit old. And so I was working a W-2 job, a lot of hours, 100 hours per week in the oil industry, just trying to make money so I could keep investing. And I burned out. I just thought, I don't see how I'm ever going to get to 100 single family homes or whatever my goal was back then. I'm not even 20% of the way there and I'm burned out. And so that prompted a whole new shift of perspective and mentorship. And I started learning about passive investing. I started learning about multifamily syndications, private placements, whatever you want to call them, and other vehicles that I invest in too today that just produce passive income, where I'm not involved in the business at all. I'm just the guy saying, here's some money, and then send me some residual checks every month. And that grew to be even a bigger expansion of realizing what investing can do for people. And so, long story short, that's what I do today. To your point, I help educate in the space of being a passive investor, which is what I do full time now. Every single one of my investments is a hands-off investment. I don't do anything actively, not a GP, not a house flipper. I don't do any of that stuff at all. So that kind of brings us through today, and working with Ashcroft Capital to kind of get the word out. It's just a group I've invested with for many years. I've known Joe a long time, and we do a lot of conferences and speaking gigs and educational content. So I love it.
So what was the actual business motivation to switch to the passive investing, like versus active? Because you've been on the both side of the coin, basically. You've been active,
right?
And then you focus now only on the passive. So what was the actual motivation?
Yeah. My motivation was that I didn't like my W-2 job. I was working a job I quite frankly hated, and I needed a way out. And I didn't see a way out other than if I had enough passive income every month to where I didn't need that job, I didn't have to be reliant on it. I could then have the freedom or the flexibility to pursue other work that I actually did enjoy and did want to learn. So there's this saying, I forget who coined it, but it's like, be a yes man until the day that you don't have to be. And so that was kind of my story. It was like always saying yes to money, and like, you want to make $100? Sure. What do you need? And eventually it was like, I really don't enjoy doing this stuff. I'd rather pursue, my passion. So long story short, I had these single family homes, and I ran the numbers for the first time, essentially a net worth calculation. I was like, if I sold all of these properties and I paid realtor commissions and taxes and fees and everything, and I let the dust settle, and what am I left with in my bank account? And then what if I took that money and I put it into these passive deals one at a time, and I diversified 50K here, 50K there, times, a bunch of deals? How much passive income could I potentially have? And when I realized it was enough to leave that job, I was all in. I didn't really have to think too hard about it. I was a little skeptical because it was a new asset class I hadn't explored. So I did one deal. I let it set for about 6 months just to make sure it was a real thing, and that it made sense, and that I wasn't missing something. And then from there, it was real. So I started diversifying and doing a whole lot more of those.
So what is your actual criteria on investing? Because I think, first of all, you mentioned that you were looking for a passive income so you can live on. Yeah. So also the second point you mentioned is diversity, to have different asset classes in your portfolio. So what is your focus right now when you, as a passive investor with Ashcroft Capital, with other operators? And I think you more the focus is going to be on south of US, like Florida and all of this stable markets, not the appreciated markets, unless you disagree with me.
Well, I think markets can change. Like, I wouldn't have always said that Florida was a growth market, for example, at least not like Orlando, Jacksonville, Tampa in the past. I think it's becoming that as more and more people are now moving there. We're seeing big appreciation in markets like that as compared to, say, a Memphis, Tennessee, which is notoriously known as a cash flow market, and things like that, parts of Indiana, for example, or even Ohio. So, but yeah, your coastal markets have historically been your growth markets. You want to go invest in San Francisco or Manhattan, you're hopefully doing that for future appreciation, not cash flow, because it's awfully hard to cash flow in those markets. So I've always been inspired or motivated by this concept of buying something at a discount, fixing it up, making it better, and now it has more worth. And we don't even have to be talking about real estate. I mean, that could be like a vehicle. I'm going to buy it from a friend at a discount because whatever situation they're in, they need to offload this car. It needs some work. I go and fix it by myself or with some connections cheaply. And then now I have this running vehicle in good condition that's worth more than what I paid for it. And I love that concept. And so I apply that to real estate. And so what I invest in, to answer your question, is value add Class B multifamily in the Sun Belt markets for the most part. I mean, there's exceptions to that. I've done some Colorado Springs and some Michigan and Arizona, and well, Arizona Sun Belt, but other markets we'll say. But in general, that's my bread and butter. That's what I've done for the past 7+ years, is that model primarily. About 80% of my capital's gone towards projects like that. And then 20% has been diversified outside of that completely into experimental things, into things like, say, cryptocurrency or self-storage or mobile home parks, or just different ATM machines, first lien notes, stuff like that, publicly traded REITs. So ideally, the things that I invest in have an appreciation component to them and have cash flow starting immediately right out of the gate. And the cash flow I use to live on, and the appreciation I don't count on. And if it's there, it's there. And if it's not, it's not, whatever. And I just roll it over into more investments as things sell, if it happens to come to fruition, but I'm very cognizant that every asset class has market cycles, and the next 10 years in multifamily isn't going to be the last 10 years. And there may come a day that appreciation is much lower than what it was before. And so I'm a cash flow guy at the end of the day. If I can just clip a modest cash flow coupon, I'm all good with that.
So going back to the next point, it would be, you as a passive investor, how you can select your operational partner. What is the main points you're looking for when you're dealing with a GP or like a operational partner to select?
The biggest mistake that I made, that I see a lot of other people make, is starting with the deal. It's show me the deal. What's your deal? What are the returns on your deal? The deal. What market is it in? What unit size is it? What's the age of the property? I start now with my own goals. What am I trying to actually accomplish here in 5 years or 10 years, whatever the trajectory is? What makes sense as an investment to get me there? Everybody's different in that way. And again, back to a component of cash flow and a component of appreciation makes a lot of sense. Real estate makes a lot of sense because I've done it firsthand, actively first and now passively. It's an essential need of people. People need a place to live, safe, affordable workforce housing. We don't always need Netflix stock or Peloton bike stock or something. I mean, they're kind of a little more discretionary. So I'm not a big investor in things like that. So I start with my goals. Then I start with kind of the macro level situation, like where are people moving to? Where are companies moving to? What are the landlord tenant laws in different places? What are the state taxes in different areas? And I'm just trying to get a big picture glimpse so that I can start identifying what markets make the most sense. It's why I don't do a lot of investing in California or New York, and I do a lot more in Texas and Florida for these kinds of macro reasons. Then I let the GP, this is where I'm finally getting to vetting the GP to answer your question, who is investing in those markets in value add deals with Class B properties, doing whatever, a fund model or individual deals, whatever, your criteria would be. And then I start vetting them. What is their track record and experience? Do I agree with their philosophy and big picture? Do they specialize in this niche, or are they all over the place doing all kinds of different business models? I like to work with specialists. And from there, it's then I get to the deal. The deal kind of comes last, in my opinion. And, if you're working with a reputable firm with a track record and markets that you like, that are growing and expanding, that are diversified, you've already got a lot of things going for you. The last thing is hopefully they're doing a decent deal in that area, and that you can just sort of ride the tides there, so to speak. So I try not to get caught up in analysis by paralysis. I made some big mistakes trying to get too far into the weeds early on and kind of disagree with assumptions and underwriting and saying, why is this line item that? And maybe this should be that, or they're overpaying for landscaping on this property, I'm not going to do the deal. And then in hindsight, I watched those deals go full cycle, and I watched investors double their money. And then, I sat on the sidelines thinking that was too aggressive. And so, my whole thing is, if you're working with experts, let them do their job. If you're going to be an investor in a stock, for example, Apple computers or whatever, let the CEO and the developers and the VPs just do their job. Don't try to nitpick them to death and think you know better than they know, because, that's the whole point. You're a passive investor. So,
but you as a passive investor, you are more sophisticated investor, because what you're explaining is to one, analyze the market. So this is basically the importance of coaching investor, even if they are passive, to understand their criteria, to able to judge if they're gonna go with option number one or option number two. Because as you said, first of all, analyzing the market, analyzing your operational partner, understanding their niche, and so on. So yeah, it's a really valid point.
I call it, just real quick on that note, it's a great point. I call it actively passive, because it doesn't matter if you're going to be an actual investor, like a true professional investor in anything on this planet. You have to have some active component to that, right? If you're going to do the stock market, you can't just start throwing crap at the wall and seeing what works, right? Like you need to read a book on stocks, you need to
100%.
listen to a few people. So that's the whole point. Get a foundation, listen to podcasts like yours, read a few books, maybe find a mentor who's been doing it a while, pick their brain and get the foundation laid, and then start diving in. You got to take action too. Of course, that's maybe the most important thing. But
let me ask you about something else about your partner. So usually when you're dealing with really experienced GPs, usually the return is less. When you're starting with a newbies, okay, the interest is higher, but the risk on the same time high. So right now on this market, when you're dealing with GPs, with the inflation, the appreciated market in different states, what is your criteria or your target return on investment per year?
Yeah, it's a great question. And this is part of what I help educate other people on is things change. There was a time in our US history that you could go down to your local bank, deposit your money, and get a 10% annualized return right there, taking virtually no risk and having FDIC insurance on top of that. Pretty sweet deal. Times have changed. That's not how it works. Now you don't even get 1% in most cases. So you have to adapt as an investor. You have to be able to pivot. You have to be able to realize that when I started doing these syndications in 2015, a lot of the deals were 8, 9, 10% cash flow right out of the gate, day one, and then onward and building up from there. Today, we're seeing 4, 5, 6% cash flow out of the gate on the same types of deals. That's because we have a lot more competition, a lot more money is flooded in. This has become a very popular sector. And so you have to adjust as an investor, not just because, to your point, which you're right, in a generalization, if you're working with someone experienced, they either have higher fees to justify that, to say, look, we've taken 50 deals full cycle, and here's our track record. It's phenomenal. So, you can go work with Joe Schmo over there and maybe get a higher return, but he might lose your money too. So, or you could go with us. We're a more trusted, reputable brand. That's just kind of how it works, unfortunately. And it makes sense, right? I mean, if an investor is looking at two deals, a brand new operator who's never done a deal and someone who's done 50, they can't be equal return projections. I mean, why would you take the added risk? So you're going to have to do something for those investors being the new guy.
So right now in your market, what is the current range of return on investment for passive investors? Because usually you have different structures. You can go with 30-70 plus the preferred return, which is I'm gonna talk about, which is the guarantee as a passive investor. What is your negotiation to understand that, of course, this is not a guarantee return. This is basically your best effort, or the general partner best effort to guarantee this return.
Yeah, it's an alignment of interest, right? It's the general partner saying, look, the the first available positive cash flow that this thing produces, we're giving 100% to you, the investor, before we start sharing in that, before we start taking our fees or dipping into the profits. So that's all it is. Now, if that deal goes south and doesn't perform, well, you're not going to get the preferred return because it just isn't there. You can't create something out of nothing. So it's a great point. There's no guarantees in any investment, stocks, bonds, mutual funds, even putting your money in the bank. I mean, the Great Depression run on the banks, and even FDIC has its limits. And, anyway, different conversation. But so to your point, so in my markets, I'm investing in Class B value add multifamily between 200 and 600 unit in size of properties. These are sought after by a lot of institutional capital, so pension funds and REITs and mutual funds and syndicators. So it's a very highly compressed area, but highly sought after. I'm seeing cash flow projections in the 5, 6, sometimes 7% range annualized in year number 1, and then building up maybe to 7, 8 in year number 2, and then maybe 8, 9 in year number 3. Again, these are just projections, but this is what I'm seeing from a bunch of different operators. And I'm seeing a total return, which is IRR, internal rate of return, when you calculate cash flow and equity upside combined, of between, I would say, 13 to 18%, somewhere, kind of in that broad range. So, again, past performance isn't indicative of future results, and these are just projections. And this is not naming any one particular sponsor. This is just what I'm seeing as a limited partner in the space in 2022. And, quite frankly, if those are achievable numbers, I'm still very happy with that. I mean, you look at what's happening to the stock market this year, I'd rather have a little more stable, consistent, less volatile, potentially double-digit return over the next few years. But
the same for Bitcoin.
Yeah, well, yeah. That's true. So anyway, yeah, that's my broad take on it.
I think the next one, or the next question will be, as a passive investor, what is your strategy to deal with fund manager and syndicators? So what is your better approach is to have an actual, because as you mentioned, you're looking for track of record, which is going to be better with maybe a fund manager, but at the same time, you have syndicators with higher fees. So what is your strategy here if you're trying to choose between the two different operators, fund manager or syndicators?
Yeah, I like to go. Yeah, no, that's a great question. So I like to, first of all, I invest in all of that. So with that as a broad disclaimer, not anti any one thing. There's a time and place for everything, and I'll tell you a good example. Back in March of 2020, when the stock market collapsed because of the pandemic and because of fear and uncertainty, everything got pulled down, including REITs, real estate investment trusts, that were in the market. So these things, a lot of them were cash flowing a little bit lower than a syndication, so maybe 4 or 5%. Well, all of a sudden, they went 40% off, so that cash flow went way up. And so if you were to have bought, which I bought some, but story always goes never enough. And then they recover in price. You would have got a great cash flow because you bought literally at a 40% discount. So that was an opportunistic play, But in the private markets, there's different opportunities. You have to be, strategically, you have to have an upper hand, to get something like that. So anyway, all of that to be said, I like to go directly to the source. This is my, the more layers, the more middlemen, the more, this person's involved and it changed hands to this person. And then there's a manager that does, with the REIT structures and stuff, some of them, I'm turned off by that. So I like to go right to a GP who's directly doing their own deal, who's, doing their own capital raise and the whole deal. That's just a personal preference. And, but there's pros and cons to others. I work with a co-sponsor as well, and he co-raises for different groups. But the cool thing, first of all, I like the guy a lot. We get along. We have great conversations. He's introduced me to a lot of great operators in the space that I never would have been introduced to, that maybe I couldn't even go directly to if I had wanted to. So there's pros and cons to all of this. But as far as the crowdfunding platforms and different things like that, I just prefer to go right to the syndicator themselves rather than using a middleman or a platform or a fund manager, a fund of funds.
Yeah, 100%. So, but if you are comparing return wise, what is going to be the better approach? Always a syndicator in your opinion?
Yeah, it's a good question. It'll be deal specific. And someone on social media a few weeks ago sent me this Vanguard real estate fund and said, I heard you on a podcast talk about syndications, but why wouldn't I just invest in this? You know, and they sent me the ticker symbol. And I said, well, few things. I mean, I'm not telling you what to do or not to do, but here's a couple things to think about. Volatility is the biggest. Cash flow yield was about half of what you might expect in a syndication. And then the multiple layers of fees and not really knowing what exactly you're investing in. How many properties do they have? What are the breakdowns of each of those properties? You really don't know that stuff. And they're always buying and selling. And I've just learned from being in the private space that we're the group that's selling our deals to a lot of those mutual funds, you know, after we're finished. So we come in and buy it, we renovate, we make our 20-30% return, whatever it is, we sell it, they're the buyer. And so I wouldn't necessarily want to be on that side of the coin. I'd rather be the group that came in and bought it off of them because it's got a lot of deferred maintenance and it's really old and it needs updates and it's below market rents. I'd rather be on that side of the coin, like I described earlier, and kind of riding that wave up and not buying it kind of at the top. But personal preference, man, you know, you do you.
So going to this part of the coin, which is the fees. So how you as a passive investor assess the fees of the GPs, including like the profit split, the acquisition fees, the management fee. So you, as you said, you have different operators, but how you manage to say, okay, this is the correct number. This is too much for me.
Sure. So generally speaking, I mean, you've got three types of fees, kind of an acquisition fee up front for closing the property and finding it, doing the underwriting, raising the capital, doing the legal docs. That's kind of like a reimbursement and hopefully a little profit for the group for putting it together. You have an asset management fee, which is the ongoing fee they collect just to make sure the business plan is happening and in accordance to what they told investors. And then the back end should be the largest fee that the GP gets to collect. And it's if they meet or exceed their projections, they're going to share in those profits on the sale on the back end. So a common split might be, let's say 70-30. 70% of the back end profits go to the limited partners, 30% to the general partnership. You might see 80-20 split. You might see 50-50 split. You might see 60-40 split. Everyone's got a different way of doing their deal. What I always look at is this. Again, starting with my goals, does it match my goals and criteria? Is it in the market I want to be in? Is this a trustworthy, reputable operator that I'm working with? If all these things check out, at the end of the day, and a lot of people may disagree with this, I look at just the net projections to investors. And if I'm happy with that, I really could care less what the fees are. You know, they could take 99% of the profits, but if I'm still getting an 18% IRR, all right, you can have 99% of the profits, because to me, that's a solid return as a passive investor. And I'm good with it myself. A lot of people, again, disagree or get greedy or think, you know, this group over here charges half of that, whatever, go with them. But yeah, I'm in a deal, by the way, it's not a real estate deal, different kind of structure. The GP takes a total of 66% of the total profit and leaves 33 to everybody else. I'm good with it because that still is a double-digit cash flow return that's paid out monthly to me, and that's I'm A-okay with it.
I think the good numbers about the IRR is about 13 to 17% in different markets. So if you're achieving this as a passive investor, you're good.
Yeah, well, you know, if you could get any kind of consistent double-digit return over time, you're outperforming the stock market. You know, there's one simple way to look at it.
Yeah. So my next question is, as a passive investor, what you're looking for when you're dealing with a GP on the side of communication and reporting?
Personal preference, I like monthly distributions because I live on cash flow. And with monthly distributions usually comes monthly reporting. And the reason I like that is I feel a little closer tied to my investment. I get to know what's going on month by month, how the occupancy is changing, what kinds of renovations are getting done, the financials. I don't have to wait a quarter. There's been a couple instances where I did quarterly deals. And so you wait 3 or 4 months and all of a sudden you get the update and it's like, okay, we're pausing distributions, or whatever. Or it's like a tornado hit our property 2 months ago. Forgot to tell you about that. And I'm not a fan of it. I'm a fan of not over the top communication. I don't need a weekly email or a daily email, but I think monthly is a good frequency. I get to skim them, again, actively passive, right? Takes a little bit of active involvement, but I scroll through these things in 20 minutes or something and I'm good. There's my monthly work, quote unquote, to manage my portfolio.
So what is your focus on the report when you're looking as a passive investor? What you're looking for?
Yeah, making sure that we're hitting the target projections. If we're not, what's going on? Why is that happening? What's getting put in place to, make that happen? Making sure that occupancy and collections are 90% or above in most cases, so you're still stabilized. You're still going to be in good shape. If things start dipping down into, mid 80s, low 80s, then it's like, I need to know what's going on. Why is it that low? Is it just because we took over the property and there's a lot of turnover all of a sudden in month number 1? Or is it that, they're building a brand new apartment building next door and a lot of people are choosing to rent there and not our place? It's important to understand this stuff. And the reason I'm so macro level is because I accept that at the end of the day, it's really not in my control. So again, I could sit here and nitpick these monthly updates and make phone calls, but it is what it is. I made a bet. Some are going to outperform, some are going to underperform, some are going to perform at expectations. And if I can just get that aggregate average, then, I'm good.
So what is your previous experience in a situation when you had a sore discussion with your GP? What was the discussion? What was the outcome, and how you approach the actual conversation with your GP when is the actual performance is not performing well?
Yeah, it's a good question. So as a GP, is a good point. Anyone who's listening who may be active or an aspiring GP, my advice is give your investors a lot of information, try to address every potential question in your updates, right? Again, that tornado example. If a tornado hit the property, if a fire happened, if a flood happened, tell your investors, not next week, not next month, not next quarter, tell them today and let them know what the plan of action is and how it's getting resolved and what the impact is and how many units are down and what that might mean, all this kind of stuff. Because all you're doing if you don't is you're setting up a whole line of emails and phone calls that are going to come flooding in on every single thing that you don't address. So what I do, even from the beginning of vetting a deal before I invest, I try to read all through the PPM, the operating agreement, the overview. I listen to any webinars or, recordings about the deal. I try to make notes on every question that I might have. And then anything that's not addressed, those become my questions, at the beginning of the deal. It's like, hey, I heard you say blah, 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 but I didn't hear you talk about the exit cap rate projection. Can you tell me what you're, assuming for that? Or you didn't talk about rising interest rates. What's your thought process on that? Or what are you doing to help mitigate that risk? I'll ask those kinds of questions. And if it happens to be, to your point, the negative thing, hopefully they addressed it fully in the email. If they didn't, it's just a normal conversation of just, hey, I realized there was a flood in that area and this property was affected. Tell me more about it. How many units are down? What does that mean? Did you file the insurance claim? I mean, what's the damage going to be? What's the turnaround? Do you have contractors lined up to start working on it? Just a normal conversation. Things happen. We have to be realists that tornadoes and natural disasters and flooding and fires, they happen. So that's why, to me, it's why I diversify. Big fan of Florida, live in Florida. Don't like the hurricanes in Florida. Don't like the insurance in Florida, right? Don't like sinkholes in Florida. And so I own properties here, but I own properties in Texas. don't like tornadoes in Texas. I don't like hail damage in Texas. So I have some that are in Georgia, and so you get the point. Diversify.
Yeah. I think my next question will be, what is your exit strategy when you're looking to partner with a GP? Especially that on the syndication business, we always go with a commitment between 3 to 5, maybe 7 years. So what you're looking for when you're checking the opportunity to partner with any GP, especially on the PPM, shareholder agreement, and all of these structures. So what is your perfect approach to have clean exit strategy from this project in case you have any other commitments?
Yeah, I think the first thing for everyone to realize when you're a limited partner is, again, once you wire the funds, sign the docs, and close the property and you're underway, it's an illiquid investment. You have to accept that. Never put 50K into a deal if you think, hey, in 3 months, I might need that 50K back. This is not the right investment for you. That you might look into other things in the publicly traded markets or just stay in cash or something. So with that said, I realized that it might be 3 years before I see that capital back. It might be 5, it might be 7, it might be 10. I just don't know. But in my experience, I try to work with operators based on their track record who have said, we always underwrite for about 5 to 7 years, but we normally sell at year 3, year 4, something like that. And I kind of like that. It's not a promise or a guarantee, but hopefully it's what I call velocity of capital, right? I like getting my proceeds back as soon as possible, either through a refinance or a sale, so that I can put them back out there into more deals and I can keep levering up my cash flow. And so to me, the sweet spot is 3 to 5 years. I mean, that ideally in a perfect world, it would always be 3 to 5 years and I would get my money back plus any, appreciation that's there. And then I would, put 50K in a deal. It would turn into 100, let's say. Then I would take the 100 and I would diversify it. I'd do 50 in this deal and 50 in that deal. And then those 5 years later, then I would do 4 more deals, and diversify those. So that's just my personal take on it. I mean, there's a lot of opinions out there, but that's how I do it.
My final question about your criteria is, who is your influential mentor who basically help you to have this shift from the passive to from the active to the passive part?
I joined an in-person pre-COVID. It was back in 2015, so definitely pre-COVID. In-person real estate meetup group. It was out in Boulder, Colorado. 2 gentlemen in their 60s, maybe early 70s. They had sold their businesses in the mid 1990s, and all of a sudden, kind of overnight, unexpectedly, came into a windfall of cash and became investors. And so they had made a lot of mistakes. They started putting their money all over the place in stock market and real estate and private placements and venture capital and startups, and made a lot of money, lost a lot of money, learned a lot of lessons. And so by the time I had run into them, they had a lot of experience being a full-time investor. And so I would ask them, what's been the number one investment consistently that you would kind of endorse, as something to look into or learn about? They were the ones that turned me on to real estate private placements, specifically in the multifamily sector. They've been doing this a very, very, very long time. They've probably done, 150 of these deals as LPs. And it was the first time I kind of had that light bulb moment. You can actually be a full-time passive investor if you want to be. I mean, that's an option out there if you've got some capital to go put to work and you can, offset your living expenses. So they were my 2 mentors that got the ball rocking and rolling. The more I've been in the industry, the more I've attended conferences, the more I've listened to podcasts, I've ran into a whole lot more full-time LPs. I'm sure a lot of your listeners know of Jeremy Roll. He's a big, LP out there that speaks out about being passive. Spencer Hilligoss was that for a long time. I think now he's more active, but there's a lot of people, I'm not going to sit here and name drop everybody, but they became mentors of sorts too. So I'll vet a deal myself, all on my own time, make some bullet points. And then sometimes if I'm still a little unsure, I want to get a second opinion, I leverage my network and I just say, hey, let me send you this deal. These are my notes and my thoughts. Is there anything I'm missing or that you see differently? And, it's teamwork, teamwork makes the dream work, right?
100%. For the people to follow your success on passive investing, what will be the channels for them to follow you?
Yeah, so I open up my time for free to people. You mentioned, coaching. I don't do that per se, but I do, let's call it mentoring for free on 15-minute calls. So ashcroftcapital.com/Travis is my calendar link. You can also find my calendar link on LinkedIn, Travis Watts, or Facebook, Instagram, Bigger Pockets. I put it out there to the world. I talk to all kinds of people week to week, not just about Ashcroft, but just about being a passive investor, accredited, non-accredited, newbie, 75-year-old, very experienced, sophisticated, guy, gal. So reach out. I'd love to help and connect. And if I can be a resource or point you in the right direction or answer some questions, happy to do that.
Thanks a lot. This will be great, I think, advice for all of the newbies to learn about how they take a decision and start to work as a passive investor. Again, thanks a lot for your time today, and we're really happy to bring you again to the show and appreciate it.
Adam, thank you so much. Thanks everyone for listening.